November 19th, real estate and mortgage rate update. A lot has gone on, and what I'm going to cover today is primarily around the government shutdown, reopening, and the Fed rate cuts. So let's jump into some numbers here. 30-year fixed, we're moving in the wrong direction, 6.36 national average. FHA 5.99 national average. Now what I did was I took the median home price in Clackamas County, which is 602,561, putting 20% down. Here's your loan amount of 482,048. Here's what your resulting principal and interest payment would be. 30-year fixed, $3,003. 30-year FHA, $2,887, and 30-year VA, $2,890. Again, kind of moving in the wrong direction, and there's a couple key reasons why, and it's contrary to what most people think. So it started back on September 17th. The Fed made a 25 basis point or quarter point cut to the Fed funds rate. Now, there is a misconception oftentimes that I hear that people think that there's a direct correlation when the Fed intervenes and either raises rates or cut rates that has a direct impact on mortgage rates. In other words, if they were to raise rates, then mortgage rates go up. Or if they were to cut rates, then mortgage rates would come down. That isn't the case. Now, in previous updates, I've explained that mortgages are based on a bond called a mortgage-backed security. And if you think about a bond, its biggest enemy is inflation, because you've got a fixed return on over a long period of time. And as inflation starts to go up, it erodes the value of that bond, and therefore rates have to go up in order for there to be an appetite for people to invest in those bonds. Now, what we saw on the 17th, and as you may recall, each of these bars represents a day of trading. Green and up is good for rates, red and down is bad for rates. So you can see, not only did we lose ground on day one, it started a downward trend. And then, it took several weeks to kind of equalize out. And then we got to October 29th, and the Fed cut another quarter point, and boom, we're in this downward trend. Downward meaning mortgage-backed securities, upward trend in mortgage rates. And so that's not good. But what it lends us to believe is that, as these things kind of like equalize out, and specific to the government shutdown, what we're going to get tomorrow is the much anticipated BLS jobs report, which was stalled out as a result of the government shutdown. So tomorrow, 5:30 a.m. Eastern time, we get the jobless, all the jobs report, BLS jobs report, all hitting first thing in the morning. And that's really going to dictate the movement of these mortgage-backed securities. So prior to the government shutdown, we were seeing softening in the jobs market, and that was actually helping with mortgage rates. It also helped the Fed make the determination to cut the overnight bank rate. Now, again, the Fed tries to intervene by moving the Fed funds rate in order to either slow spending, consumer spending, or stimulate consumer spending. So when in the face of rising inflation, they will start to raise rates in order to slow spending. Now, if the economy starts to slow down, if unemployment starts to rise, they start to cut rates to stimulate consumer spending. So if we see tomorrow that there's softening in the jobs report, which there's an expectation of, the market is expecting 50,000 new jobs, which is already low. If it misses that mark on the downside, we should see, some really good movement in mortgage rates. But again, because of the government shutdown, that was stalled out. So tomorrow's report is actually going to be September's jobs report. So we're kind of way behind, almost 2 months behind on the reporting on this. Now, you may recall too that previously there were a lot of revisions, negative revisions, significant negative revisions, so much so that this new administration fired the director of the BLS, the Bureau of Labor and Statistics, for kind of errant reporting. So let's see kind of how things kind of measure out with this new reporting. Hopefully it's more in line with what's actually happening, and we can start to see, actual market performance, and therefore, a lot of this stuff will track more accurately. So in the meantime, what we're seeing is, again, this kind of the wrong direction for mortgage rates, hoping that we start to see some improvement in this move back upward. That will happen with kind of a risk on. And now, again, when we look at a finite amount of money in the marketplace, what happens is you've got institutional investors and so forth that when things are going well in the economy, there's exuberance. We're beating expectations on earnings reports. NVIDIA is going to be a very, very big report that comes out, I believe, tonight. And when things are going well, then money flows out of bonds and into equities, stocks, to take advantage of those gains. And that can kind of hurt mortgage rates. Conversely, risk on would be unemployment starts to rise, job market softens, maybe companies are missing earnings. If NVIDIA misses their expected earnings, then we'll see a risk off and money will flow out of equities into the safety of bonds, and we'll see mortgage rates improve as a result. All right, so a lot to cover. Sorry for the longer video, but we'll keep you posted. Stay tuned for the next one.